A company is a separate legal entity from its owners, meaning it can own property, incur debt, and be sued. It provides limited liability protection for its shareholders. The main benefit of a company structure is limited liability. Shareholders are only liable for the amount they've invested, protecting personal assets from business debts. Companies are owned by shareholders who invest capital into the business. The number of shares owned determines the level of control each shareholder has. Directors are responsible for managing the company's operations and ensuring compliance with legal and financial obligations. Directors can be shareholders, but they don't have to be. As a separate legal entity, a company can enter into contracts, own property, and take legal action independently of its shareholders, providing more operational flexibility. A company constitution outlines the rules and processes for running the business, including how decisions are made, directors' powers, and the rights of shareholders. Companies must comply with corporate governance laws, ensuring accountability and transparency. This includes regular reporting to ASIC and keeping proper financial records. Companies are taxed as separate entities, paying a corporate tax rate. This tax is applied to the company's profits before distributions are made to shareholders. In Australia, large companies pay a corporate tax rate of 30%, while small businesses with a turnover under $50 million pay a reduced rate of 25%, encouraging small business growth. When a company distributes profits to shareholders as dividends, those dividends are taxed. Shareholders must declare the dividends in their personal tax returns and may receive franking credits. Franking credits are tax credits passed to shareholders for the tax already paid by the company. These credits help avoid double taxation on the same income when dividends are paid. If a company's turnover exceeds $75,000 per year, it must register for Goods and Services Tax (GST). The company must charge GST on its sales and lodge business activity statements. Companies employing staff must register for pay-as-you-go (PAYG) withholding. This requires the company to withhold tax from employee wages and remit it to the ATO. Companies must pay superannuation contributions for employees, ensuring compliance with Australia's superannuation laws. The current minimum rate is 11% of an employee's earnings. Companies must keep accurate records of all financial transactions, including income, expenses, and employee payments. These records are essential for tax compliance and annual reporting. Companies are required to file an annual company tax return, reporting their income, expenses, and tax payable. This is separate from shareholders' personal tax obligations. Companies must pay CGT on the sale of assets, but unlike individuals, companies are not eligible for the 50% CGT discount. Instead, the full gain is taxed at the company tax rate. Companies may qualify for small business CGT concessions if they meet specific criteria, potentially reducing the amount of capital gains tax owed when selling business assets. If a company incurs losses, it may be able to use loss carryback provisions, allowing it to offset those losses against profits from previous years and claim a refund of tax paid. Companies can offer employee share schemes, allowing employees to buy shares in the company. This can align employee interests with company performance and offer tax concessions. Companies must file financial reports with ASIC, depending on their size. Larger companies must provide audited financial statements annually to ensure transparency. Directors have legal responsibilities, including ensuring that the company meets its tax obligations. Directors can be personally liable for certain unpaid company taxes. If a company becomes insolvent, it may be wound up or enter liquidation. During this process, company assets are sold and creditors are paid before any remaining funds go to shareholders. A company structure provides limited liability, a lower corporate tax rate, and various tax advantages for shareholders.